Good morning or good afternoon, and welcome to our webinar, Developing Your Risk Appetite During Volatile and Uncertain Times. Are you tightening, staying the course, or leaning in? My name is Jeff Rigsby. I'm the Chairman and CEO of Finance 500 and CB Resource, and I will be conducting today's session. First, I do want to take the opportunity to thank all of you for taking time out of your busy schedule. I know it's tough to carve out an hour or so of time, so I certainly respect your time, and I will keep on schedule. And for those of you that are not familiar with Finance 500 and CB Resource, we are based in Irvine, California, and together we serve over 1,000 community banks across the country. We are leaders in enterprise risk management, strategic planning, and capital planning, which does include a strong practice in targeted liquidity and interest rate risk management. And our fixed income group on the broker-dealer side is one of the largest issuers of broker deposits and solutions in the country, averaging just over about $5 billion a quarter. What we find that makes us different, particularly on the funding side, is our unique awareness. Because of our strategy and risk management practice, we just have a keener insight to our clients' needs. And I think that's what actually keeps us up in the top 3 or 4 in the country on the funding side. So that's a little bit about us. So let's go ahead and move forward. Again, just getting the most out of the webinar. If you have any questions, by all means, there's Instant Messenger. Feel free to use it. We will have a Q&A at the end. I'd like you to think of this a little bit as a working session and a dialogue. Break out a piece of paper or something you can jot on. I think there is an opportunity to take some notes here as we peel back the onion and get into the process. So to the extent you're into working along with me, I'd like to create a framework that you can actually, take some of the things that come out of today's session back with you when you're working with your senior executive team and or your board. The presentation material will be available upon request. So if you want this presentation deck, we're also recording the session, so it will be available via recording as well. So I have a simple purpose today, and I always like to start my sessions with a goal or a purpose. So today it's really about how to learn a useful process to assist you in developing and aligning your bank's risk appetite when you're responding to what I would characterize as market sensitive, market volatile, or these uncertain times. So and we'll get into risk appetite definitionally here in a minute, but we are in some unprecedented times. So understanding our risk appetite is nothing more than a articulation of our strategic intent. How do we respond to these times? So we're going to talk about the economic impact and these considerations leading into it, then a brief definition, so we're all on the same page on risk appetite. And then becomes a working session. And if you think about it, I really want to focus on 2 of the 3 deliverables that you do get out of a risk appetite session. One is just building that heat map, right? What is our risk appetite? What is our credit risk appetite? What is our interest rate risk appetite? So where do we plot that on a map? How do we plot that on a map? And then you can't leave it at that, right? You have to define what you mean. So how do we develop a risk appetite statement? Many of you may already have risk appetite statements developed and so forth. So this could just be a finding touch. But that's going to be the deeper dive. And then I'll have some closing thoughts, and we'll get into some Q&A. Very sensitive to time, but it's pretty hard not to talk about what brought us to where we are today. So I want to spend just a few slides on just the conditions that set this impact in motion. And if you think about it, we almost need to go back to kind of fourth quarter 2019 rolling into Q1 of 2020. And that's when the pandemic kind of rose in. And if you think about it on this chart, it's right here. And all of a sudden, something unprecedented occurred when COVID hit. And for us collectively in our industry, we had a surge. We had a surge of deposits. So if you look at that dark blue line, that's basically saying over about a 5 or 6 quarters of time, our industry grew $4.5 trillion. That was stimulus money. That was PPP loans. That was people not spending. And all of a sudden we found that our banks are glut with liquidity at a super low price point. Now, the other phenomenon at that same time was if you took PPP out of the picture during that same 5-6 quarter period, loan demand was relatively flat. So here we are, we have all this inventory and perhaps not as many options as we would like as far as how do we optimize those fundings. So I just want to say a little something about, so what ended up is we got a little derailed. And if you think about it, I just want to show you a quick snapshot. And, you know, I've been in banking a long time. Most of you have been in banking a long time. We like to operate in a certain rhythm or what I call a desired tension. We have a certain amount of loan growth. We have a certain amount of deposit growth. We balance these two in kind of a narrow band. And when we're at our best, we have this good tension. So if you look at this gray area here, this is pre-Great Recession. And you can see that dark blue line is loan growth. The lighter blue line is deposit growth. And they're running neck and neck. And this is just a sweet spot for banking. The Great Recession hits, it gets literally banged up, right? Everything gets a little disassociated, gets knocked out. We survive that, and we come in right back to that desired tension. And we have one of the greatest prosperity runs when you think about the balance between cost of funds, loan demand, profitability, asset quality. And that ran from about 2012 all the way through fourth quarter 2019. As a matter of fact, we were starting to talk at that time that something had to change. And something did change. And all of a sudden you see this discontinuity occur where bang, all of a sudden we get this surge of inventory. Loan demand does not follow it, and it knocks us out of our rhythm, right? Widest gap between deposit and loan growth, and certainly over 20 years, but I will tell you, we haven't seen anything like it in my 40 years of banking. And so what happened? And this is all what is leading up to our time now. So what did we do? Well, you know, we had all this funding, we had a certain amount of loan demand, but most of us found we had excess liquidity, and all this orange line just represents here, this orange trend line, is a large number of banks, a larger number than ever in the past, increase their level of securities, increase their level of bond holdings. And it just was the right thing to do. We didn't want to put it in overnight funds for a couple of basis points. So we worked at investing those funds. And in so doing, that created another new phenomenon. And again, kind of knocked us out of our rhythm. Look at this 20-year band of how we run when we look at asset growth, loan growth, deposit growth, and securities growth. Again, securities kind of spiked a little bit in the Great Recession, but not to a huge exponential factor. Knocked back into our rhythm, nice steady rent, and boom. You know, my only point here that's leading up to this economic condition, it really started with us getting out of our rhythm, if you will. And so boom, that hits. So another new phenomenon occurs. And this is something that really was more of a balance sheet item. But when we looked at GAAP accounting standpoint, all of a sudden we used to have tier 1 capital and in our tangible common equity. We're always relatively neck and neck. Again, kind of went into the Great Recession, maybe got knocked out a little bit. But boom, all of a sudden, during that same time, with that rising interest rates, as we started seeing that occur in 22, and moving into this year, all of a sudden our tangible common equity having to be adjusted with the negative AOCI. So now our capital levels are just out of whack, right? From what we're accustomed to. So, you know, in a snapshot, all it really says for many of us, many of you that had a big surge in deposits, and maybe you used to run at 5 or 10% in securities and the balance of your earning assets were in loans. Well, that picture has changed. And so what you're seeing here, and you know, if you want this deck, you could do a deeper dive. But when we took a look at this phenomenon, our question was, if we look back over 5 quarters, what's going on with people that have a certain level of securities? So what's going on with banks that have, say, 10% or less in securities? What about banks that have 25% or less in securities? What about banks that have 25% or more in securities, or even 35% or more in securities? Changing that mix, changing that balance sheet composition. And so just so you can see it at a quick glance, this purple trend line up here are the banks with the fewest number of securities. So they saw the least impact on their ROA though we see it trending down in Q1, you can see the group as the level of securities grew, earnings trended down, right? So somehow for those banks that managed to do less with securities, managed to drive higher net income. And by the way, the banks we're looking at in this study were really banks that fall within 100 billion to 5 billion. So kind of the sweet spot of the nation. That's where the majority of the banks are. I know some of you on this call are larger. A lot of our clients are larger than 5 billion, but this represents kind of the lion's share of banks out there in the market. So real snapshot, something if you'd like to get a copy of the presentation and do a deeper dive. But what it showed us is, in a nutshell, is the banks that had the lower percentage of securities compared to banks with a greater percentage of securities are, as of the first quarter of 2023, it's a little slightly different picture. Their ROA is at the inflection point is about 99 basis points better than those with the largest percentage of securities. Now, their cost of funds is 60 basis points higher. So strangely enough, they're making more money, but their cost of funds, and that's what you'll see in the upper right-hand chart, is the banks with the higher level of securities actually have lower cost of funds. Banks with fewer securities had higher cost of funds. Net interest margin, banks with the lowest percentage of securities had about 100 to 107 basis points better in this first quarter, I'm sorry, of 23, than banks that didn't. And yield on earning assets, again, not surprising if many banks ended up going maybe longer than perhaps they wanted to. I think the average duration out there is somewhere between 6 and 7 years. Some of you are as low as maybe 3 years. Some of you might be higher into the double digit. But when you look at average duration and then composition, you've got a lot of those security portfolios that might make up 60, 70% of mortgage-backed securities. So anyway, the net effect on yield on earning assets between low and high is about 166 basis point spread between banks with 10% and less securities versus banks with, say, 25 to 35% or more in securities. So just a quick snapshot. And then, so what we have to ask ourselves, so if that's our current condition, we're probably not looking at any interest rate relief in the near term. I mean, I like Wells Fargo's economic groups. This is just a quick snapshot from them, but we're looking at, perhaps Fed funds capping out at the latter part of this year, or certainly early 2024, and then some decline. Well, we need some interest rate relief to get some relief on that balance sheet. And you can just see in this purple line as well, on the near term stuff gets down below 2.5 out here in 2024, and out here at the longer end, it's up in the mid threes. Much more desirable place than where we are today. So we have those factors, a couple other just touch points. According to the conference board, and they do this probability index on the recession, as of their most recent study, which was May this month, they're basically saying within, there's a 99% probability that there will be a recession to some extent, right? And within the next 12 months. And then lastly, we've got this phenomenon that probably many of us have never really experienced at this magnitude, but now we have this industry reputation condition, call it the Silicon Valley condition, call it the shaken confidence condition, but we get brought into this point with a combination of bank stocks being shorted, social media being able to move funds, or social media taking the message out there, and then the digital availability of funds really created this industry reputation disruption. So a lot going on. When you summarize it, here's where we are, and this kind of brings us back to our risk appetite discussion. But from an interest rate risk standpoint, what we do know is we're in this rising interest rate environment. So that's no question driving up our cost of funds. But we also have this condition where there's still a high degree of competition for lending product out there right now. So we're all dealing with this somewhat artificially inserted cap on just how much we can charge, but there seems to be this relentless increase in interest rates, 500 basis points over 5 quarters. So we're dealing with this compression, right? So we got this downwards pressure on yield and earnings. So we have this interest rate risk factor to consider as we look at our strategic intent, as we look at our risk appetite. From a liquidity standpoint, well, what the Feds give, the Feds can take away, right? So they created stimulus, they created low interest rates, they created this phenomenon of a level of liquidity we've never seen in probably most of our careers. And then all of a sudden, about 5 quarters ago, they decided they wanted it back. And all of a sudden we started seeing, 12-month treasuries top it up around 5%. So the Fed action has resulted in a strain on liquidity, right? And in increased cost of funding. It also messes with the balance sheet a little bit, right? So if you've got negative OCI and you've got your tangible common equities dipping a bit, the ability to shrink your balance sheet as an offset to reduce some of your cost of funding becomes difficult. A couple more areas that, just as we wrap it up, this is kind of depressing me a little bit, but it's when you talk to banks in their operating condition, the market's actually pretty favorable. But credit risk, the only thing I'm seeing on credit risk standpoint is there are some concerns now, or increased credit concerns regarding CRE on the office side. So if you're a lender and you have a good chunk of office space, that could be a sensitivity, and wondering where we are going forward, as well as consumer loans. Strategic risk is just this rising interest rates, mark-to-market activity. It does affect the balance sheet. It does affect capital markets. So a lot of us were relying on some of our growth coming from this just ongoing industry consolidation. We were funding our growth through sub-debt or new equity. Some of the tools we have to drive greater value in our strategies are somewhat constrained in this current environment. And then lastly, that we talk about that reputational risk, right? Market forces, stock market conditions, social media vibes. It's created this tsunami effect that's affected all of us, even in the heartland of our customers coming back and saying, hey, how should we feel about our uninsured deposits? Or us asking the question, how should we deal with large deposit concentrations, things of that nature? So that's our world. So let's migrate quickly to taking those factors and talking about how that plays in risk appetite. So quickly on risk appetite, just COSO defines risk appetite as, and I inserted bank, but risk appetite is the level of risk you're willing to take or prepared to accept to achieve your financial and strategic goals and objectives. I mean, that is what your risk appetite is. Your strategic plan basically says what your risk appetite is implicitly. If you put it in a heat map, like you're looking at to the right there, that's explicitly saying, I am going to drive my strategy. I am going to drive my earnings, my shareholder value by taking X amount of risk in credit, X amount of risk in interest rate risk, X amount of risk in liquidity risk, X amount of risk in operational risk, compliance risk, strategic risk, reputation risk. And you can expand on that. If you have a payments platform, that's another area. Trust, services, wealth management, higher risk products or compliance risk. Anyway, you can expand the heat map. We're going to keep it kind of to the key risk categories for the purposes of our session today. As you think about it though, this is something if you haven't done, you can even take this presentation, sit down and work with your executive team and in your board on this. But you really want to come away with 3 things, 3 outputs when you're working on your risk appetite. One is that heat map. Tell me what level of risk I'm willing to take. Is it low, low, moderate, 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 high, high? Those are kind of the ranges that we typically accept when we're talking about risk appetite. But looking at a heat map, saying the level of risk you're willing to take, doesn't really communicate as much as you need to communicate. And that's why we have risk appetite statements. Risk appetite statements should consist of 2 things. It should basically define the level of risk you're taking. So in other words, when you say my credit risk appetite is moderate, then you should be able to add to that primarily because of my appetite for growth, the level of concentrations I accept, my involvement in specialty finance, whatever it might be. You want to define that. And you also want to do a little second paragraph on your controls. And then you want to develop those KRIs or KPIs, your key performance indicators, key risk indicators, like you're seeing on this table to the right, because the whole point in having a risk appetite established is being able to articulate what your tolerance levels are around that risk appetite so that you can start tracking the movement of risk over time, right? And you can watch it move across your risk tolerance levels. Now, just structurally, just just as far as giving you some insights as to the process, we do this a lot. But here's what I suggest you do: you take your strategic plan, you put together your team, if it's going to be your executive team, for example, but dissect your strategic plan so you can get a feel for your intent. So you're going to ask yourself, how much are we growing? Where are we going to grow? Who do we serve? Are they complex? Are we in a mature market? Relatively static dynamics, or are we adopting new technology? Are we going digital? Are we going cannabis? All these factors are in our strategic plan and create the framework for us to have a targeted discussion about our risk appetite. Once you do that, you establish your risk appetite heat map, you develop your statements, and then you do that condition that I mentioned about developing your risk tolerance levels. Now, what's the different factor about today that maybe is different from what we've done in the past when we look at risk appetite is what is our strategic response based on today's disruptive environment, right? So it's not like we haven't seen economic change in the past. Any of you that have been around for, say, 20 years or more in banking, you've seen at least one or two cycles. But now we're coming into another cycle. Nobody's really articulated just how bad it's going to be. In many cases, many of you in your own markets might say, you know what? Our local economy is pretty good. I have been in Nebraska. I have been in Texas. I've been in Iowa. I have been in Arkansas. I've been in New York, upstate New York, Pittsburgh. Generally speaking, the economy in many of the banks I've talked with is still pretty darn good. So all of this stuff we're hearing and seeing, we haven't necessarily seen it kind of affect, say, the quality of our credit. We're definitely dealing with rate compression. Everybody's dealing with rate compression. So the question you want to ask yourself, though, when you're working with your risk appetite is, do I fall into one of these categories? Given everything that we're looking at, do I feel more comfortable strategically to hunker down? That means, do I tighten my credit? Do I get lean, right? Do I cut my costs? Do I just prepare myself for better times and mitigate any extenuated losses? That's one strategic intent. Your risk appetite will look a certain way if you choose to do that. Many of you might look at all of these factors and say, you know what? This just doesn't really change our expectations. We feel we could grow at the rate we want to grow. We feel we can make what we want to make. Maybe we're going to be a little more careful, maybe a little more prudent, maybe a few less exceptions, but we're staying the course and I'm keeping my risk appetite kind of where it's at. And then lastly, there's those of you who are saying, you know what, if people are hunkering down, that might mean more opportunity for me. And you're leaning into it and your risk appetite is going to look differently, right? You may have a contrarian position. It still may be more organic growth than acquired because it's pretty tough to acquire something today in today's market, given the balance sheet. But we'll see, you know, what you do there is I want to take more. I want more than my fair share in these disruptive times. Last thing to consider is risk appetite is all about the movement of risk, right? So it's how much and how fast. So your risk appetite, it will go up based on two factors: how much and how fast. You want to do a lot of stuff and you want to do it quickly. You're taking on more risk than the bank that does fewer things more slowly. You want to grow and grow fast. You're taking on more risk. You got a certain degree of complexity, the nature of who you serve, what your product offerings are, the number of markets you're in, the number of channels you have, your dependence on technology. Those are all complex factors that drives your risk appetite. What level of asset quality you're willing to accept or not accept drives your risk appetite. Concentrations come in multiple forms: geographic concentrations, depositor concentrations, CRE concentrations. All those factors indicate what level of risk you're willing to take, low to high. And now we're adding into that, how do we adapt, or what should our risk appetite look like when we take this outlook, this environment into consideration? So the balance of our time is, let's just go in and look at each one of these key risk categories and ask them questions. And if you don't mind, I'm just going to assume you're like when I'm working with my clients and we're sitting there and saying, okay, we know what our world is. So we consider what our strategy is when we look at our specific markets, we look at our portfolio factors, meaning, so let's just start with credit and we'll work through each of their key risk categories. If you're tightening, you're probably leaning a little bit to the left. If you're staying the course, depending what that is, maybe you have a lower risk appetite anyway, or you're leaning in. But what are some of the characteristics about your strategy that you want to capture in your risk appetite? And what moves you more to the left or right? If you're tightening, my guess is you're going to pull back maybe on growth a little bit. Right. So maybe you're not going to expand as much as you wanted to. So you're going to take that into consideration. And maybe that's going to say, hey, when it comes to growth, I'm going to go from moderate to low moderate. Because I'm not going to grow 10% this time. I'm not looking for more than my fair share. I'm actually happy if I have a modest growth rate or if I just stay flat. So I'm going to shift my, when I consider growth, I'm going to the lower risk side. Or, hey, I'm assuming a bunch of people are tightening up. I'm leaning in, even though my risk appetite in the past might have been moderate. Maybe it's more now. Maybe I'm going to try to pick up more business while these others tighten. I'm gonna take that on. And then ask that same question as you look at the key considerations in your portfolio from a credit standpoint. If you're a commercial real estate lender, what's your makeup? Do you have high concentrations? Are you vertically tied in? Are you big in hospitality? Are you big in office space? But take a look at those concentrations. The more your concentrations are, say, elevated, use regulatory guidance, 300% on owner-occupied CRE, for example. If you're butting up against that or even more, you're taking on more risks than the banks that don't, right? You want to try to quantify that. What is your use of exceptions? Do you have tight policies, but do you use exceptions? Each one of those things. So as you're jotting down, if you got a piece of paper out there, just literally write down growth and go low to high. Are you going to pull back a little bit? You're going to stay about the same? Are you going to go after more? That should give you a sense of the amount of risk you're willing to take. That comes with growth. Are your products relatively non-complex? Are you a specialty lender? Are you doing certain types of loans or products that take on certain risk characteristics? Do you serve multiple vertical markets? So you're a CRE lender or an SBA lender, but you might have 5, 7, 10, 12 vertical markets, maybe more. That's complex. So what does that say about the level of risk you're willing to take? You want to capture that. You want to take a look and say, when it comes to the complexity of my products, I'm probably maybe more moderate high. Or if I'm in a mature market and I do owner-occupied, non-owner occupied CRE, I do a little bit of C&I and mortgage, then from a product standpoint, maybe it's on the low mod side, right? And then who do you serve and how do you serve them? I know some of you are venturing into cannabis. Well, somebody please send me an email when you move out of deposits and into lending, because I wanted to talk to that bank that makes the first cannabis company loan. But if you're lending to companies or types of customers that have higher risk profiles, you want to capture that. So without going into every one of these bullets, think about what you're willing to do or not do. Risk appetite always comes back to two questions. What am I willing to do? Or what am I not willing to do when it comes to credit risk? How much do I want to grow? What do my concentrations look like? What does my product mix look like? Relatively benign, relatively modest, or is it relatively complex? Am I partnering with new fintech partners that are opening up my markets, opening up my credit risk to a point of maybe even leveraging AI or other means to make credit decisions? All of these factors get into the level of risk you're willing to take. What's so interesting in today's market is you probably knew where you were before. Does being in a perhaps weakening economic condition or this balance sheet conundrum we're dealing with, do these factors change the level level of risk you're willing to take. If you've got rising cost of funding right now, and your alternative to that is either generating more fee income, cutting costs, or increasing your yields, do you take greater risk? Do you expand your product line to take greater risk in credit, knowing that we're potentially going into a weaker economy? Welcome to risk appetite discussions. These are dynamic, engaging discussions, though, that really help us articulate just what we're willing to do and not do. The reason I want to stay on credit for just a moment, because in the end, it's not a bad thing to take on more risk. It just gives you a sense of, if I'm going to take on this risk, are my controls appropriate for the level of risk I'm taking? If I'm using a digital distribution platform, if I use brokers, if I've got multiple channels of distribution, how do I monitor, track, and control that risk? That's really the beauty of risk appetite, is it articulates the level of risk you're taking so that you can set up a control structure and an infrastructure to control that risk. That's all it's about. Okay. So that's kind of credit risk. Let's take a look. Interest rate risk, a little more interesting today, right? From where we might have been a few years ago, maybe 2019, you were more in that maybe 5-10% securities, and you use securities just to round out your earning assets. Maybe you were more of, you optimized your lending capability. And so you were looking at interest rate risk really from a relatively benign perspective, right? I'm going to get the lowest possible deposits, which we all want, lowest possible deposits, low cost, stable deposit environment, and good diverse loan portfolio, giving me an above average yield. Between the two, I get a great spread. That's a relatively low risk profile. That would be a relatively low risk appetite profile. And then you start layering on. It's like, okay, so I want to optimize my balance sheet and I have excess liquidity. I need to evaluate alternatives. If I can't lend it, where do I go? So here's that same series of questions you ask yourself when you're working with your finance team. What am I willing to do or not do? If I'm going to let's say run at a higher yielding earning assets. I have specialty lender clients where, to be honest with you, they just don't want to compete for deposits. Everybody's going after either specialty deposits or small to mid-sized business checking accounts, and they just don't have the energy. They're good lenders. They have above average yields. They don't throw a lot of energy into something that they can't master. So they focus on their higher yielding products and build that, and look at managing a open market funding solution that maintains their spread. I've got clients that are watching their cost of funding rise rapidly, but because of their specialty loan portfolio, their yields are rising at the same level or better. So they're still maintaining that spread. So as you're working on your risk appetite when it comes to interest rate risk, what are you willing to do? Right? Are you willing to pursue non-traditional investment alternatives or higher risk loan alternatives to optimize yields? And what does that look like? How does that break down? If you're doing it from an investment standpoint, what level of tools will you use, whether it's swaps or other derivatives, to hedge your bets? So the more you're willing to look at alternatives that stress the envelope, the greater the risk you're taking. Now, in the market we're moving into, is this a time you want to take greater risk, or is this a time where you start tightening and try to keep your cost basis as low as you possibly can? Remember, the beauty and what drives community bank and literally small to mid-sized bank values for many of you in that category is the quality of low cost deposits you have. So you never really want to lose sight that you want that low cost relationship based deposit base that's relatively lower risk. But going after it and building it is the challenge. So anyway, when you think of interest rate risk, think of the complexity again. of what you're willing to do or not do to create the optimum spread. And if your risk appetite for either investment strategies or loan types that might be pushing your risk envelope, then you might find that, you're just going to hunker down right now, try to get some saves on cost and not get out over your skis on your balance sheet. But the more you're either looking at exotic investment opportunities or other factors that might elevate your risk profile, that's really what you want to articulate here. If you're conservative, you do most of it through loan lending and you have good loan portfolio and you have good relationship-based deposits, the interest rate environment is going to self-correct at some point in time. But here's the area that I think we've seen one of the greatest risk on, and that's liquidity risk. So let's pause there for a minute and think about how our liquidity world has changed over the last 8 to 12 quarters. So if you go to Q1 in 2020, many of you experienced this surge in deposits, and all of a sudden you had more deposits than you ever imagined. We got out of that rhythm we were talking about earlier. So what are you willing to do from a liquidity risk standpoint? And whether it's a cost factor, whether you're willing to run leaner, but you really have to ask yourselves, where does my loan to deposit ratio fall? Where do I like to keep it? Some of you like to run up there around 90 to 100 to 110%. A lot of you CRE lenders or you SBA lenders, you don't mind running hot. And so your liquidity risk appetite runs a little hotter. You might want that above average growth. You're going to go out and fund it through alternative funding. So if you have an above average appetite for growth, or if you're one of those banks that want to lean in these tougher economic times, you're probably going to take on a little more liquidity risk. If you're willing to run that above average level of loan to deposit ratio, if you want to run 95 or better, that's an above average appetite for risk. You want to capture that. Many of you might have a large number of large deposit concentrations. If you're not neutralizing that, and you're willing to just live there, and in this interest rate environment, even those larger depositors, which have probably been loyal for a lifetime, may be coming back to you and either asking questions about their uninsured levels, which you have options to deal with, or just diversification. As we run those higher uninsured levels, those higher concentration levels, we need to acknowledge the level of risk we're taking, and that should be captured in your risk appetite statement. And if you're adverse to alternative funding, that's fine. You have a lower risk appetite for liquidity. If you're willing to use full open market funding alternatives to achieve your targeted levels of liquidity, your targeted levels of growth, then you're willing to also leverage open market, what I call open market funding, which would be anything from IntraFi or certainly Stonecastle or broker deposits or other wholesale FHLB advances. Now, if you're one of those banks that tipped up on the tangible common equity and you got a little strain there and even got to the negative, you might have a little more trouble with your FHLB advances. But when we, again, get to liquidity, it goes back to what you're looking for on the deposit side. So you want those lower cost deposits. There's not as much risk taking when you're going after those lower cost deposits, but they're tough to win and they're tough to keep. So the big thing about liquidity in this market right now is, even though it's more costly, with this reputational and industry related risk, do I want to keep my levels up and take less liquidity risk? Do I want to reduce my liquidity risk, have more liquidity, even though it's costing me more? So that's the question when you're sitting with your executive team. It's balancing, do we tighten up? Do we pull back on our growth level? Do we try to get more diverse in our deposit mix? Do we go ahead and add some non-core funding just to give ourselves a little more liquidity? And what's that say about our risk appetite? But if you're one of those people that want to lean in, you're going to say, I'm okay at running above average loan to deposit ratios. I'm okay at using alternative funding sources. I'm okay at managing my relationships with my larger depositors, understanding that there might still be some blowback on the uninsured side. Those are factors we take into it. Again, if you're tightening, you know where your lower risk, you know where your risk appetite is going. So I think what you might be finding as we get through these first 3 or 4 risk categories is In tougher times, it's almost, there's a natural inclination to tighten, which would be lowering your risk appetite, meaning I'm going to wait to fight another day. It's a little too uncertain for me. It's a little too volatile. I'll try to find some saves. I'll try to keep a tighter eye on my credit portfolio and on other balance sheet considerations. If you want to stay the course, or if you want to lean in, just accept to maybe stay the course today or to lean in. You are going to take greater risk. Have that discussion. And there's nothing wrong with that. As a matter of fact, some of the best performing banks lean in, but you can't lean in without asking the question, are my controls equal to the level of risk I'm willing to take? So it's pretty easy to tighten and just weather the storm. But if you're one of those that in tougher times want to stay the course or lean in, understand your risk appetite's likely to go up, and you just want to make sure your controls are appropriate for the level of risk you're increasing. And I think you're probably getting the rhythm now as far as when you move into operational risk, what drives operational risk? Again, if you have a modest level of growth, if you're in a mature market, some of the things that drive operational risk, you may be on the lower end. You may already be kind of low, moderate, or moderate. But as you start looking at growth, that adds a tick up in operations, because if you grow operationally, what happens? Transaction volumes go up. Number of employees go up. Perhaps the complexity of your customers goes up. Perhaps you're adopting new technologies, or you want that digital bank. This is one thing I'll say, operational risk, though some will argue that it gets greater in tougher or uncertain markets. I think to some extent it just comes with size and complexity. There's just a one-to-one relationship with size, complexity, and operational risk. You want to grow, you're taking on more operational risk. You're going to add people. You have a big remote workforce, you're taking on more risk. What does that do to your risk appetite? How do you capture it? What is the role of technology in your operational risk? Do you have a payments platform and a bunch of ISOs? And by the way, take that back to liquidity and talk about what a big surge of ACH activity does to liquidity. But all these factors have to do with what you're willing to do or not do in each of these key areas. So when you're thinking of operational risk, look at transaction volumes. Now, many of you might have been part of an M&A structure or an M&A strategy. And I know a lot of people still want to look for those M&A opportunities. I just think it's going to be tougher over the next couple of years because of valuations, because of capital markets and other issues. So we probably won't see as much M&A. If you were big on M&A, your operational risk would usually be, appetite would be higher, right? Because you're going to integrate people and systems and products and all those other factors. But when you think about operational risk in this type of economic environment, I don't know if your appetite really changes that much. I think it still comes back to growth. It comes back to the complexity of your products. It comes back to the characteristics of your market. If you're in a stable, mature market, you're probably not taking on a whole lot of risk. If you're relying on a traditional branch system and bankers, you're probably not taking on a lot of operational risk. But it's very hard not to suggest you're taking on more risk if you're going to continue to grow, if you're going to continue to add technology, if you're going to continue to add partners and leverage on technology. So just take that into consideration. As a matter of fact, looking at this sample statement to the right where it says our operational risk appetite is moderate to moderate high when considering our desire to adopt technology solutions that enhance our client experience and improve efficiencies. We also are exposed to an increased level of risk associated with ACH and wire volume and size and growing dependency on third-party providers. That might be one way of them describing whether their risk appetite is moderate, high. Okay. So again, in a tougher market, if you're tightening, your risk appetite would probably reflect that. If you're doubling down on growth or willing to take more risk, be ready to just ensure your controls are appropriate for the level of risk appetite you're taking. A couple of, just on the glide slope down here, compliance risk. If compliance risk is one of those interesting things as far as you only have, from a compliance standpoint, think about stakeholders, right? When you say compliance, you're pretty much dealing with regulators. But so what is compliance risk sensitivity? So let's just define that a little bit first. The more consumer business you do, inherently, it's going to be more compliance risk associated. If you're a mortgage lender, you just have more compliance risk than the bank that doesn't. If you're in trust and wealth management, you have more compliance risk than the bank that doesn't. If you're getting into higher compliance risk businesses, which could include MSBs or cash intensive businesses, cannabis, those things all have a higher compliance risk characteristic to it. I don't know if compliance risk is necessarily affected by the environment, other than are your regulators more sensitive to your business model because we're in uncertain market times. But when you think of compliance risk, think of consumer sensitivity, think of the level of vendors that you need to manage as it relates to your business model. The sophistication or scalability of your platform has something to do with compliance. But generally speaking, I think compliance risk is compliance risk, regardless of the economic and market conditions, other than the fact that regulators right now are going to be heightened sensitivity to your business model because they're worried in tough times. But compliance risk is compliance risk. But if you're a commercial bank with limited consumer exposure and commercial lending, commercial deposit gathering, and that's your business forte, chances are your compliance risk appetite will stay on the lower risk side. But if you're seeking broader partnerships, more, say, if you're going down BaaS, if you're looking at leveraging your technology platform to expand, that would increase your risk appetite for compliance risk, certainly number of partners and business lines and business customers, right? And multiple channels. Again, I don't see this economic time changing compliance as much as I did in those other areas. Now, certainly strategic risk does have some material consideration. Again, if you want to grow in these times and you had a growth plan, it may be tougher to grow today. We have bigger issues today. We have our cost of doing business is rising faster than our ability to offset it with yields on a general basis. So when you think about strategic risk, again, come back to growth. And is your growth going to be modest? Is it going to be average? Is it going to be above average? Is it going to be quantum? And how do you do that strategically in today's economic environment? Do you take on the same level of risk you've always taken on? Or do you see your risk taking going up? If you're hunkering down, do you pull back on growth a little bit? Does acquisition kind of come off the table for a while? Do you not launch certain new products? Do you tighten in other areas? So strategic risk really gets into preservation of capital, preservation of good asset quality. And so you might actually say, you know what, I'm just going to accept earning less right now because these uncertain times of this market volatility has us too nervous, and our shareholders will be happy if we just tighten. So I'm going to pull back on my risk appetite. I used to be around moderate, but because my appetite for growth is going to be tempered, I am going to actually look to shore up my capital levels. I might even look to elevate my reserve levels. I'm going to probably stick with the products I have today. I was looking at launching some new things. Those are all tightening characteristics, and that would have a direct impact on your appetite. Again, staying the course to me today, for many banks, is taking on more risk. We're getting squeezed. We have volatile markets. We have certain market uncertainty. We have reputational risk like we didn't have before. So even staying the course, you might want to go through each of these conditions and say, hey, if we're going to maintain this growth, are we taking on more risk to do it? If we're going to be working with these partners and growing our technology solutions, are we taking on more risk just to get to where we wanted to go? Do we slow down our channel expansion? Do we slow down our new market growth? Do we slow down on pursuing those new customers? Do we still run a little leaner? Do we stretch our capital? Staying the course might elevate your risk appetite. And then if you're leaning in, that kind of speaks for itself. But again, strategic risk has to do with the amount and speed in which you're going after what you're doing. If you had a big quantum growth strategy, multiple channels, multiple markets, adding new employees, bolting on new markets, does that work in this economy? Do you feel comfortable in this economy? Does it suck up more capital? Those are the kind of strategic risk appetite questions you want to have and plot that low to high, taking those key considerations in. Lastly, I just want to touch on reputation risk. And this one's interesting, right? Because reputation, we all have 6 stakeholders. There's only, I'm going to say 6 considerations when you think of reputation risk, right? So you have your employees, your customers, your investors, or certainly stakeholders, your regulators or stakeholders, your communities or stakeholders, and your partners or stakeholders. That's 6. So first of all, that's your entire landscape of reputation risk as it comes to who you serve or who you work with in your ecosystem. So again, if you're growing and you're pursuing growth opportunities, does that in today's world take on certain reputation risk? Do you hunker down because you're not quite sure where this whole industry reputation thing is going to go? Is there another First Republic around the corner? Is that going to create some sort of backlash? Is our industry going to take some sort of hit because we do or don't fund our national budget? All those figures are, so reputationally, do we say, again, we might tighten, we might hold back a little bit on a growth a growth strategy. We might want to just retain a good working workforce. We're not looking to expand a lot of products that create new tension or run the risk of not doing it properly. So it's again, what do we do? Are we tightening because things are a little uncertain? Are we committed to staying the course and we'll elevate our controls to do that? Or are we going to say, man, in for a penny, in for a pound, I'm leaning in. So I am going to continue to grow. I will elevate my reputation risk because, I'm expanding in compliance areas, product areas. I'm going to probably leverage my capital now, and I may not have the capital markets to go to that I had a year ago or 2 years ago. So I'm probably going to run a little leaner on capital. So my regulators might not like that. So reputationally, I'm dealing with that. Right. So those are kind of the key factors we think about in these various areas. And I know I'm doing a flyover, but I hope you're capturing the theme of each one of your risk categories characterize the thresholds of risk or the tolerance levels that you're willing to take. And these are meaningful discussions. I mean, I have these discussions annually with the executive teams of our clients, or many of our clients. And we spend time on this discussion because it's material. And it's bringing in the quantitative data along with it. But it's how much and how fast. It's where, it's who, it's all those factors. But doing it in this framework really creates a well-structured way to support your strategic intent. And to be honest with you, in the end, it increases the probability of success of your strategic intent. The more you understand and define what you're willing to do or not do, the better you're going to be at setting the controls to control that, the better you're going to be at reducing the number of unforced errors. And that's just how this works. Lastly, my comment on key risk indicators. This is just a credit risk scenario, but once you understand what your risk appetite is, the heavy lifting is saying, okay, if my risk appetite in loan growth is X, or my risk appetite for non-performing assets is Y, and concentration levels and other things to do with your loan portfolios, then you have to spread that out over tolerance levels so that you can track that movement of risk over time. So that if you see it leaning in a certain direction, you can pull it in, you can calibrate. If you're running a little under, you might want to lean in and do more, but just using a dashboard like this, and I think you could shoot us a note if you want a checklist of what good KRIs and KPRs are. But this is just my point on that. So I know this is a broad discussion. We've covered a lot of broad topics, but I really just want to reinforce that your strategy says what your risk appetite is. But when we get into uncertain times and we get into volatile times, in many respects, these are the best of times for business. If you've got your arms around your business model and you understand exactly what you will or won't do to achieve your intent, right? So just a reminder, what brings us all together: get your strategic plan out, spend the quality time with management and the board to go through each of those risk categories and dial in what you're willing to do and not willing to do in these times. As you look forward, drawing your own conclusions of where your markets are going, where your customers are going, how far your capital can run, how your liquidity levels will hold up. And establish that heat map, establish those statements. And I just want to point out too, if you do this well, and call this an ERM pitch, but if you do this well with risk appetite, you do know it calibrates your entire ERM system. It calibrates your entire risk assessment system, because if you define what your risk appetite is, it's better to define the assessment process to judge if your controls are appropriate or not, and where the emerging risk and threats come from. So just a thought there on bringing it all together. Whatever you do, don't confuse risk appetite with risk profile. Your risk appetite is your desired state. But what's important when you've established your risk appetite is you can go and conduct an enterprise-wide assessment and look at what your inherent risk is, and look at what the quality or controls are in your residual or composite risk and direction of risk. And just understand that if you're out over your skis and appetite, if your controls don't hold up on your assessment system, this system is designed to pull you back, right? To rein it in. So just some closing thoughts. Risk appetite does define what your bank is willing to do or not do to make money and create value. When it's used properly, it can certainly establish the appropriate response to these uncertain times, for sure. And you will decide somewhere in where you live between or among tighten, stay the course, lean in. And that's a really important discussion to have today. And I will leave you with one thought. Just remember that just because you're really good at something doesn't mean you're not taking greater risk. So never get lulled into the sense because you've mastered something that what you're doing doesn't have a elevated risk characteristic to it. It's just important to understand that never get lulled into that. So just before we get into Q&A, just a quick pitch on us. This is what we do. Our enterprise risk solution, our strategic and capital planning, liquidity and risk planning, we operationalize these things with our bank clients so they can optimize their value. So I hope you'll reach out to us and look to learn more about how we help our customers define their risk and optimize their performance in good times and bad. I certainly want you to take advantage of our funding to the extent you're looking at alternative funding. We are the best at this. We are, like I said, number 2, 3, or 4 in the market all the time. If you need that alternative funding source to round out and manage the risk of liquidity and cost, we can get that done for you. So with that, I'll see if we have any questions. Yes, one nice straightforward question is and I can answer it. So what is available? The presentation is available. So if you like this slide deck and you just want to, I have had banks tell me they've actually used it as a backdrop to help them develop their own risk appetite with a spreadsheet. So the presentation is available. It's also recorded. I don't know if you want to hear me talk over the slides, but it is available. So yes. So if any of you, if you want a copy of it, you can just reply. I think you can request it through Zoom. You certainly, Robert Finch is our primary point of contact. He's our director of sales and marketing. And Robert's contact information is in this system. But I hope you found this insightful. When we move into more disruptive times, which I think it's clear to say we've moved in disruptive times, and to some extent we were party to creating this as we went through COVID, which got us all disrupted. but disruptive and uncertain times can be the most opportunistic times. In going through exercises like this, dialing in specifics on your controls and what you're willing to do or not do to optimize your business model in today's world. It's, uncertainty, that adverse times represents and creates great opportunity. So I'll leave you with that. I hope you enjoyed the session, and please reach out to us if you would like to learn more about how to do this yourself or have us help you. Thank you for your time today. Take care.